Welcome to you all, and thank you for joining us on our webinar today. We truly appreciate your time and interest. Before we begin discussing our topic, synthetic identity fraud mitigation, let me remind you that the participant lines will be on mute for the duration of this webinar. You can submit questions to us at any time by clicking on the Ask Question button in the webinar tool. We will address the questions to the panelists as time permits. With that, let me turn to the next slide and provide an overview of our webinar today. First, we will set the stage on synthetic identity fraud by discussing what it is and why we find it an important topic. We will then turn to a discussion of detection and mitigation strategies. There will be another discussion on industry collaboration and future outlook. The panelists will then have a Q&A, and we again invite you to submit questions to the panelists at any point during this webinar. And then we will have some brief closing remarks. With that, let me turn to the next slide and introduce the industry experts on today's webinar. Jim Cunha will be our moderator. He is our Senior Vice President at the Federal Reserve Bank of Boston and our Secure Payments Strategy Leader. In addition, we welcome Greg Wolf, who is Chief Executive Officer and founder of Coalesce.ai. And our third panelist is Jack Lynch, who wears a number of hats, but we are introducing him as Senior Vice President and Chief Risk Officer of PSCU. With that, let me turn the webinar over to Jim in our next slide. Thank you.
Thanks, Mary Ellen. I'd like to welcome everybody who's joined the call. Hope you're all doing well. I want to give a high-level update of what synthetic identity fraud is, and I'll go pretty quickly, but the other speakers are going to talk in more depth about some of the particular topics that I covered briefly. But before I jump into it, I also want to mention that the Fed has another initiative where we developed a classification model for fraud called Fraud Classifier. And I won't talk about that today, but if you're interested, you can follow that via the link at the end of the presentation. You can find that information. Today we're talking about synthetic identity fraud. And over the course of the last year or so, we talked to over 70 industry experts to help us understand what is the current state of synthetic identity. We issued 3 white papers. The last is coming out a couple of weeks ago. The first talked about what are synthetic identity, what's the fraud, and what are some of the contributing factors. The second paper talked about how to detect it, and the third last paper talked about mitigation strategies. What we found was there's a real lack of information and understanding about synthetic identities. So we ended up developing these papers to help educate the industry, and this effort is really to continue this particular webinar. You can go to slide 4. So first of all, what is synthetic identity fraud? A big caveat here is there is not consistent definitions in the industry about what synthetic identity fraud is, which is one of the problems. We use this one here to talk about it in the general sense, but there are others out there. So basically what happens is the bad guy will take a Social Security number. For instance, say my granddaughter who's 4 and not using her Social Security number. So they could take her Social Security number and actually create a fake persona around it. That could actually be completely fictitious information. It could be slightly manipulated information. It could be a compilation of real and fake. But they create this fake identity because my granddaughter is not using her Social Security number currently. Let's go to the next slide. So what do they do with this? After creating the identity, if you look at the second circle there, they basically submit an application for a loan or credit card. It gets passed over to the credit bureau, one of them, the 3, and gets rejected because there is no history there. But the credit bureau creates a record of that name and the Social Security number. So it creates a foothold in the system. And then the fraudster continues to apply for usually small dollar, high risk products until they are able to get, say, a very high risk credit card. And then they actually start to use it. They use it and pay it off. What they're trying to do is mimic a real person and how a real person would start slow and develop a credit score. Another option they have is to actually become a second authorizer on someone else's credit card and start to pick up their traffic. So what they try to do is look like a real person with a high credit score and then bust out, basically trying to bust out the line of credit or the credit card and then disappear. And then the institution is left with what they thought was a good customer that just suddenly disappears, and there's no way of following that for a collection. If we go to slide 6, another caveat, we do not have good information about synthetic identity fraud. These are some numbers that we found over the last few years. Fastest growing fraud type, 85 to 95% are not flagged through traditional methods. And this one's scary. 1 million children have had their identity stolen in 2017 alone. $6 billion in total losses. And so while these numbers are not hard and fast, it does give you a sense directionally of how big a problem this is. Two of the things the Fed is working towards, I should have mentioned in the last slide, is that we're now working with the industry to try to come up with a common definition for synthetic identity fraud, or common definitions. So there's really different types of it. And we're also looking at how can we get better data about fraud, because what we have is dated and not great. If you go to slide 7, this talks a little bit about some of the characteristics. So I mentioned that the fraudster tries to make it look like a real person. But in doing so, they develop some of their own patterns. And some of those patterns and characteristics can help you potentially detect fraud, especially if you're going beyond just looking at one application at a time, be it for a loan or credit. Because sometimes if you're looking at multiple of them or across your whole portfolio, you'll notice something. So for instance, in the top left, if you have multiple identities with the same Social Security number, you won't find that by looking at one application, but you'll find it by looking across multiple applications or across your whole portfolio. Same, you could have, multiple applications with the same address and phone number, or multiple accounts coming from the same IP address. So there's different things you can look at to say, does this make sense? And to the top, second from the left, I like this one. The credit file depth, how old it is and what it says, or the score a person has based on the age, just doesn't make sense. So my son is 27. If he came to me and said, Dad, I've got an 800 credit score, I would say, you're a synthetic. There's no 26-year-old out there, 27-year-old that's going to have an 800 credit score. Or if you've only been in existence in the system for 2 weeks, and you've got a great score, et cetera, that should be an indicator that maybe something's not quite right there. So the different characteristics, and I know the gentleman following me will talk a little bit more about that. If you go to slide 8, a number of years ago, legislation was passed that mandated that the Social Security Administration had to set up a new system that would allow online queries of its database, and that query could be authorized via electronic signature versus having to sign a piece of paper. And it's very simplistic. What it will do is allow you to say, does this Social Security number match this name? And it's a simple yes or no back, but it can be very powerful in conjunction with other types of tools. They're just rolling this out now. I believe the pilot is about to launch any day. And so they're starting with a number of organizations who will have a number of customers, and then from that they'll learn how to improve, if necessary, the service. So this service, we think, will have some great help in the industry, but it's not a panacea. It's not going to solve all the problems. So, for instance, you can't go back over your entire portfolio and then check them all, because you never get authorization initially to use this particular service. So like I said, going forward, it has opportunities, but it's not perfect, but we hope it'll actually help in starting to solve the problem. If you go to slide 9, just a couple of findings out of our last paper. For one thing, first of all, no one organization can solve this problem. This really needs collaboration across the industry or amongst institutions. I have a saying, when it comes to cybersecurity, it seems like it's the industry, us against the bad guys. There's a lot of collaboration and sharing. When it comes to fraud, it's not us against the bad guys. There is some sharing. There's some good efforts out there, but it's not as open from a sharing perspective for a number of reasons. Secondly, this is complex. Some of these attacks where they're creating synthetic identities are done in an automated way, so if they're applying for hundreds of thousands of credit cards across multiple banks at the same time. This is not one account at a time. So a lot of it is automated, and you can actually buy scripts on the dark web as to how do I actually create these types of identities and then use them. Changes in the regulatory landscape influences it. I just mentioned that the Social Security Administration was charged with opening up a new service. That's a plus. But in some cases, for good reason, legislation is passed or regulations are passed that may have a negative impact. So, for instance, you only have a certain amount of time to deal with certain customer inquiries or certain requests for research into fraud. And when the clock starts ticking, you only have a certain number of days to resolve a customer complaint. Well, that's good from a consumer perspective because it's making sure they're getting prompt action. But the bad guys know this. The bad guys know the Fair Credit Reporting Act limits a bank as to how much time they can take, and they use it to their advantage. You know, they flood the agencies with questions and with issues, hoping that they'll just be moved along and not researched. So it's a double-edged sword. And experts say a multi-layered approach is the most effective. So if you go to slide 10, this is a very simplistic way of thinking about multi-layered detection mitigation. So first of all, you have to look beyond the basic PII, and there's different pieces of information you can look at to try to gain the reasonableness of an application. For instance, I know of one company that if the address, with the address, they'll do a lookup on Google Maps. They have software that actually can see the image. And if it says it's an apartment building, their software will actually look at it and say, does this look like an apartment building? Or if it's a vacant lot or a gas station. So you can do a lot of more activity and a lot of more interrogation beyond just the PII. Because the original PII checks and know your customer checks were really just to make sure whether someone was credit worthy, not whether they existed or not. So they're not meant to catch this type of fraud. Then you have to look at your manual processes, other processes, and make sure that you're blending the various approaches. This is not a one-size-fits-all or one control will stop this particular type of problem. And then obviously we all have to balance what we ask of our customers and the amount of time we take with trying to get effective controls and processes in place. So obviously if you get enough controls in place that you can ensure there's not one synthetic coming through, then obviously there may be some friction there for your customers, and that has to be balanced. So let me just stop there. Like I said, both Greg and Jack are going to get into materials that will also help augment and provide more information on some of these. So with that, let me just turn it over to Greg.
Very good. Thank you. Thank you, folks, and thank you especially to the Fed for inviting us to be here. And I would like to just give a little call out to how the Fed, especially the Secure Payments Group, has really championed innovation and shown leadership for the industry in terms of how to innovate and be proactive around risks with their synthetic ID initiative and the fraud classification model. So, so my name is Greg Wolf, and I'm the founder and CEO of Coalesce.ai. And if we could move to the next slide, please, I'd like to just say a little bit about our company and how we're addressing synthetic identity fraud. So Coalesce, essentially, we're an AI company, as you can tell from our name. And before we get into that, I just would like to demystify AI a little bit. So there's obviously a lot of hype and buzz around this technology. And one of the things I always like to start off is we like to kind of divide the world of AI into two camps. One is called what we call big data AI, and the other one we call scaling the analyst. So big data AI, I think, is what people generally think about when they think about artificial intelligence. And this is like Google and Amazon AI, where you would take billions of data points and put it into very convoluted deep learning algorithms, processing thousands of machines simultaneously, essentially waiting for the computer to tell the user something they don't already know. The problem with that is it's black box. It's very difficult to understand. What we did is we take a different approach that we call scaling the analyst. So instead, our approach is more like Netflix. What you do at Netflix is you say, I like this movie or I don't like this movie, and the system starts to learn through machine learning your preference. And we've taken that technology and approach through a technology we invented called UDML, User-Defined Machine Learning, and we use that approach to essentially replicate the domain expertise of a fraud or compliance analyst and have them teach the system as they're doing their daily job to look for signs of financial crime, in this case, synthetic identity fraud. And we found that to be much more effective for a number of reasons. First, it learns very quickly because it's learning from a human who has expertise in this and certifications. And secondly, when it's important from a transparency and an explainability perspective. It's a much more simple approach where the humans feel like they're in control of this. Really, think of it as a junior analyst that's going out and doing the work on behalf of the analysts. So our focus, our platform is called SynthID Detect, and we obviously focus on synthetic identity fraud, and specifically in the area of consumer accounts, whether it's account opening or consumer lending. The other feature around our company, if we can switch to the next slide, please, would be the AI think tank. So one of the initiatives when we started the company and we launched the company in late 2017 was we put together a group of senior executives, seasoned folks in the risk and compliance space from some very large, medium, and small financial institutions to explore and explain what is AI and how could this technology be used to benefit the industry. And we landed up actually with an amazing group. The Fed has been a participant, as well as some of the other federal regulators. These are folks, in industry who've seen cloud and mobile and social come through the enterprise and how it's transformed things. And they looked at AI and said, how can we use this? And I'd say the biggest takeaway from our think tank is that we learned that for financial institutions, reputational risk is top of mind. It's the number one concern, right? Trust from the customer or the member. And as a result, what surprised us was that, even though we may have had arch competitors who were competing for alpha or customers by day, by night, if you will, they were all fighting the same battle with a huge duplication of effort against the bad guys and girls. And as a result, they were willing to collaborate. So that kind of planted the seed for us in terms of, can we take our AI methodology and use it in advanced technology fashion to enable folks to collaborate across the industry? And through this mechanism, we actually were fortunate enough to, this took off, and we'll talk more about collaboration, some of the initiatives that we're working on with the Fed and others later on in the segment. But I think one of the surprising things that we found is that folks in Congress were actually really interested in this approach and looking to modernize some of the legislation around financial crime detection and prevention. So we were fortunate to actually, through our think tank, advise some members of Congress in the Senate Banking Committee and the hearing with FinCEN, the FBI, and the OCC around how this technology could work, and then subsequently in the House Financial Services Committee with some other engagements with regulators around this technology, which actually culminated in the Counter Act, in 2019. So there's definitely a lot of interest in the space, and certainly a lot of concern and willingness on all sides to collaborate and improve things. Next slide, please. So the last slide that I'm going to present here is, I think the concern with synthetics is that we just don't really know, right? These fraudsters, hackers, a lot of it is online cybercrime. Certainly, the pandemic has exacerbated that. The concern is nobody really knows just how bad it is. And I think the Fed's initiative of trying to standardize how fraud is classified and characterize things is a great leap forward, so we can all start speaking the same language. But one of the things that we've been doing is, based on the deployments and implementations and data we're seeing from our customers and partners, is we've started publishing this Fraud Watch Index around synthetic identities. And what's interesting about this, and these are some of the stats that were included in the third white paper from the Fed, is that less than 1% of customer accounts at this point have been identified as synthetic across the customers that we're seeing. So in fact, technically, when you look at an aggregate, you'll see it's 24 basis points, so 0.24% of the accounts, which sounds like a minuscule number, doesn't it? But in fact, when you look at the loan losses, right, so let's just say credit cards, personal loans, consumer lending, when you go and trace those synthetic accounts in the lending side of the house to loan losses and write-offs, you'll see that 24 basis points of accounts for 25 to 30% of the losses in a lending portfolio. So these synthetics are very smart. They bust out, as Jim described, and they punch far above their weight. So that's a little scary. And of course, the goal of a synthetic account is to get multiple credit products from a financial institution, maximize the exposure. They go and they socially engineer exactly at what point underwriting will start to kind of identify, wait a minute, we're getting too much exposure to this customer, let's do some further diligence, and they'll ramp up their balances to just below that level, max it out, and then bust out and take as much of the cash as they can. So essentially, you see that the size of a synthetic customer is disproportionately large compared to the rest of the customer base. Okay, Jim.
Thanks, Greg. A question or two. Firstly, you mentioned AI is all about data, and there's a lot of data when you think about a customer and application process. Can you talk, and I know you're working with a number of credit unions, can you talk about what type of data does make it into your model and into your analysis to try to look for synthetics? Are there specific things that are most important from a data perspective to roll into a product like yours?
Yeah, definitely. I mean, what's fascinating to me is just how much effort the financial industry, banks and credit unions are putting into their customer identification and KYC programs. And they're capturing a lot of data from a lot of different sources. So certainly the credit reports, the equivalent on depository accounts, IP addresses, so alternative data that you might call, other factors that can be used to identify and legitimize whether a customer is real or not. The problem is that, when it comes to data, a lot of the data that these institutions are consuming are rules-based. So they'll get a lot of flags, right? They'll get a lot of fraud flags that pop up and alert flags that say, hey, here's a potential issue. And what we're seeing is that the institutions are actually spending a lot of time essentially mitigating those fraud flags and saying, wait a minute, we need to research these, we need to pen these applications, we need to investigate them. And it creates a lot of noise. And as a result, they're not typically finding the type of, they don't have the capacity to look at every application in depth and that they need to for synthetics. And as a result, the synthetics are sneaking through. So, there's a lot of data that's being used, and there's a lot of kind of indicators in that data, but AI has the ability to take it up a level and essentially replicate how an analyst would interpret that data at scale.
Great, thanks. Another question, one thing I neglected to mention up front, I mentioned that there's a lack of understanding in many financial institutions of synthetic identity fraud. We particularly find this is a problem in smaller financial institutions. When I used to be in front of people speaking versus on the phone, I'd say 10 to 15% of smaller and medium-sized financial institutions even understand what synthetic identity is or fraud is. And Greg, I know in the pilot work you're doing, you're working with a number of credit unions. So even though they're large for credit union size, they're still relatively small. Can you talk about that experience as far as the credit unions? Were they surprised by what they were seeing in the synthetic identity fraud, particularly once they started seeing the data? So is that your experience as well when you talk to small financial institutions, that they either don't believe they are at risk, or when they find out the magnitude of it, it's surprising to them?
Yeah, Jim, definitely. So, I think what we found is credit unions are obviously designed to serve, for the most part, individuals and consumers. And if you think of a synthetic identity as, as a kind of a fake persona, I think credit unions are, unusually subject to the risk and being exploited by these fraudsters and hackers. Also, as you say, the credit unions, especially and even community banks and smaller financial institutions, don't necessarily have the deep pockets of the mega banks to invest in advanced technology. So, it becomes challenging for them when, as you mentioned earlier, the automation capabilities of the hackers and the fraudsters outpace the institutions. So this is why I think collaboration is really key. Anecdotally, I think you can see how credit unions essentially, in our experience in working with credit unions, let's say the head of fraud of one of our partner customers will meet his counterpart at a ACAMS or a ACFE conference and share some information, and afterwards they'll call each other up. And I've actually seen this in action where they'll say, "Hey, by the way, there's this fraud ring, emerging out of the state, and you should look for these types of patterns." And they're doing it already. There's kind of a community network effect going on amongst credit unions, but it's informal and it's very kind of rudimentary. It's literally people picking up the phone, sending an email saying, "Hey, watch out for this." So I think this is where the opportunity lies here, and that is we can systematically create a mechanism that multiple credit unions and banks from the smallest all the way to the largest can benefit from sharing intelligence around around this type of fraud, and that way, start to identify exactly how bad the problem is and kind of plug the hole and help them stop it.
Wonderful, thank you. That's a good segue into Jack. So Jack, let me pass it on to you.
All right, thanks, Jim. Hello, everybody. For those of you not familiar with PSU, it's great we actually segued through on a credit union topic before we got it started here. PSU is a credit union service organization. We provide a comprehensive suite of traditional and digital payment solutions, and we support 1,500 credit unions, including payment processing, risk management, analytics, delinquency management, mobile platforms, and we have 24/7 contact centers to help our credit unions compete in the market. Today, I want to talk about linked analysis and the power of data. We've already touched on that in terms of what Greg's been talking about with AI, and also how it can mitigate synthetic fraud in the future, as well as other types of fraud schemes that impact our payments ecosystem. Next slide, please. I wanted to start this off and just kick it off the conversation on the power of linked analysis when we look at traditional methods of fighting fraud that apply to synthetic fraud in particular. So first, let's focus on consumer interactions with some key channels from a financial institution perspective. And by the way, this is no means encompassing. If you have merchant channels, third-party participants such as rewards, you have many more interaction touch points when it comes to payments. But think about this in terms of what Jim was talking about around how synthetic identities can be used to commit payments fraud. The challenge is each channel may have some great fraud detection tools, but in the past they were usually not connected very well. For example, one fraudster can successfully open an account, and then other channels, they can start using the card, as Jim talked about. You're making legitimate transactions. They're kind of in it for the long game. And none of the card fraud strategies that an FI is using is going to really notice anything unusual. Transactions are going well, the velocity of the card, where they're doing the transactions at. I may have some very effective card strategies deployed based on models, neural networks, consortium data, that's based on transactional activity, such as merchant categories, frequency. However, how do those strategies help me in other channels? How would I know other accounts are being opened and what type of activities are being done in other financial institutions, next door, across the country, or even the world? And also, how old is the data I'm using? Is the feed of static content once a day, a week, a month? Or as Greg's talking about, is my content data from a phone call I got from somebody or an email saying, "Hey, be on the lookout for this"? Not what I call essentially fast communication, the way the fraudsters are going nowadays. So my team is essentially reacting to new events at a human rate of speed, where the fraudsters in many cases are looking globally and looking at a digital rate of speed when they're trying to commit fraud across a wide variety of financial institutions. In fact, your customer, or in the terms of credit unions, member, may look like a great customer to you while preparing or already performing fraud against other participants in the payments ecosystem. You may not be getting hit next week or next month, but you are definitely on the menu at some point. And as Jim was referring to, not even maybe aware or even know what you're looking at in terms of when all of a sudden account somebody stops paying and you're thinking, oh, that's just a delinquent account and I'm going to send it off to collections, not even knowing truly that it was a synthetic fraudster that hit your particular financial opportunity. So if we go to slide 3, I think a key point of this, the next one here on the holistic, please. In today's world, with consumers interacting across multiple channels, I really recommend, if you're not doing this today, look at fraud from a holistic approach. Focus on the consumer themselves. Not only ensuring you're protecting all your channels, but how are you leveraging tools in a multi-layered approach? At PSU, for example, we have billions of transactions occurring around payments, with millions more interactions in conjunction with the payment transaction. These things include call center inquiries, IVR activity, digital services. People are looking at account statuses, reporting fraud, disputing transactions, just to name a few of the transactions and activities that are surrounding a payment. We know fraudsters are moving quickly, looking for weaknesses across channels and across multiple participants in the payment ecosystem, whether it's merchants, processors, consumers, device providers, just to name a few. They're going to find holes in your defense. What you have to have is a layered approach. There's no one silver bullet on a channel that you have to contend with. And to make matters worse, from a risk perspective at least, consumers are demanding frictionless transaction experience while expecting you to protect their data, keep their accounts safe, and oh, by the way, don't call and bother them. So absolutely, you could shut down fraud a lot more than you do today, but at the risk of what is your consumer going to do? They're expecting frictionless transaction, and if you're not giving it to them, regardless, they're going to look at that and move to another service provider as opposed to being treated like they're in a crime scene investigation of some sort every time they're trying to do some sort of transaction online. So we have a balance that we have to deal with in this industry. Experience and mitigation. Each organization in the payments ecosystem will have to determine what's right for them. Back to what Jim started with, one size doesn't fit all. Your balance can be much more toward risk than experience, but everybody has to deal with this every single day in this highly competitive industry of payments. So to Craig's point around AI, it's got to be an important component for the future, not faster email to your friend down the road. There has to be more ways than static models or people reviewing trending reports to uncover new fraud trends and how the world is now flooded with data, and the fraudsters are using that data themselves, using AI, machine learning, to also perpetuate fraud. You have to somehow tie this all together, and this is where the concept of linked analysis can help. Next slide, please. So talking about linked analysis, it's PSU's approach to intercepting and predicting fraud through a combined use of AI, anomaly analysis, phone printing technology, data analytics, and human intelligence. Yes, believe it or not, you need some human intelligence to solve fraud problems. I believe that concept should apply to every problem we face beyond fraud. However, a conversation for a different day. Utilizing a technology framework, linked analysis uses a consortium of data, including phone calls coming in, online banking logins, authorization data, etc. Many of those same channels we talked about earlier in the traditional approach, we monitor, you connect the events across multiple channels, and then utilizing AI capabilities, predict fraud before it happens. Now, all the channels are still going to utilize various fraud strategies and tools you have in place. For example, with voice printing, we're using consortium data and passive analysis of over 1,000 characteristics of the call itself to assign a risk score and potentially take action based on that one phone interaction. This alone has helped us save millions of dollars in fraud losses for our member owner credit unions. However, back to synthetic fraud, what if that number is legitimate? We can tell it's calling from the right location, it's the right carrier, it's not being spoofed. They've called many times before just doing legitimate transactions. This is where you see the power of linked analysis come in. By analyzing data holistically across the multiple channels, linked analysis can identify and intercept malicious patterns of fraud. This is going to enable us to meet force with force, via shared data on the threats we face collectively. I really believe synthetic fraud is an important topic. And really, when we take a look at that, really want to thank the Fed for being involved in this critical conversation. Because while we're putting these tools in place, to also what Greg is saying, there's a lot of people out there that have different definitions of synthetic fraud, different ways to handle it. We have to start coalescing around this topic in how we define it, how we react to it, and then also how we collaborate and build tools for the future to address it. Back to you, Jim.
Thanks, Jack. And I'm sure Greg was really happy when you said we have to coalesce around this problem. That's the name of his company, yeah.
I'm glad that Jack
I
presented
didn't even
it.
think about beforehand.
Yeah.
I'm just glad that Jack pronounced it correctly because it is a little tricky. Coalesce. Nice job, Jack. Thank you.
So, Jack, a question. You talked about link analysis, looking holistically at your customer and across your portfolio. So that's within an institution. So are there opportunities for this link analysis in a broader industry sense, or say across your 900 plus customers? Does it scale, and does it look the same, or are there different ways of thinking about link analysis when you're thinking about that big number?
Yeah, Jim, it's a great question. I think as an industry, we really have to look at this. When you look at even the white paper the Fed put out, in terms of the quote, no single organization can stop synthetic identity fraud on its own, I think that's really the case. The fraudster tactics are going to continue to evolve. They're going to attempt to stay a step ahead of detection, and more sophisticated fraudsters are going to operate at scale. They're not just targeting one entity in the payment system. So I think it's very important that we find ways to collaborate with data, because they're collaborating as well. You see this on the dark web. When we're looking out and doing the analysis, they're sharing best practices, they're learning from each other, sharing data in order to commit fraud. I think it's imperative that we in the industry have to start looking at ways to do that. While PSU is looking at bringing that data together from our credit union cooperative, it's a bigger picture than that. We have to move forward with sharing data, and how do we get that data across the entire payments industry? And I think it is something that we can look at approaching this and scale it.
Great, thanks. It reminds me of, we didn't include this in this particular presentation, but the FBI had a number of years ago, broken a fraud ring that was synthetics. And talk about, it's sophisticated and not just hitting one institution. I believe, if I recall, there were 17,000 synthetic identities in this one ring. They hit institutions in 24 different states, many in the heartland, so there's smaller community bank institutions or credit unions. And I believe there was also 500 businesses opened by these synthetics. So it is a big business, and, it is something that does hit many in the industry, even out of one particular group or organization. So let me just move into our next phase here, and we're compiling some questions from the audience. For the session now, we're going to talk a little bit about industry collaboration. And the first question we had, I think we've all spoken to, which is, what's the value of it? What's the importance of collaborating across the industry? I think we've all had some comments in that area. But maybe we could talk on the flip side. So what are some of the hurdles? What are some of the challenges that you see in your own worlds in getting this level of collaboration and sharing? And since we started off in this order, I'll just ask Greg, you talk about some hurdles you've seen in trying to get the collaboration, then Jack will go to you.
Yeah, definitely. And I think the one thing that pops up immediately as a obstacle / objection when we talk about collaboration is data privacy. And we all know the world with GDPR and CCPA is moving towards, doing a better job of protecting the rights of consumers and their information, which is good. And this is an area where advanced technology can help. We've all been observing blockchain going for years now, and tremendous amounts of value created there using secure sharing technology. And that's an area where we've been embedding some capabilities into our solution so that it will enable, not only can our solution look at being proactive, right? So identifying what a fraudster might look like and be proactive to alert a fraud or compliance or account opening analyst and say, here's a potential problem, but then sharing that in a data privacy secure mechanism with other members of the ecosystem. And I think that's probably the biggest challenge and frankly the most exciting space where we can use advanced technology to get past those hurdles. And I'd say that's probably the biggest challenge.
Yeah, and if to weigh in on that a little bit as well, I think there was also, and you mentioned a little before early, Jim, around a willingness to collaborate. I think we're seeing some of those barriers break down. For example, how just regarding payment system, how issuers, acquirers, merchants sharing more and more data. I think people are coming to the realization that while thinking about the data they have as a competitive advantage, there's certain data, absolutely, utilize that for competitive advantage. That's not what we're talking about here. But there is certain pieces of data that all of us have. If we start to share that, we can all win at that. For example, merchants collaborating and sending additional information in terms of transaction data. What kind of device is being used? Issuers sharing that information back. And the more we can start building agreement around the use of this data, and to Greg's point, how do we make sure that it's in a very secure environment and we're really not, we're addressing the whole privacy concerns with data and also making sure that we're utilizing it, in a very judicious fashion as it pertains to fraud. I think we're seeing inroads there, but I think more of that is necessary if we really want to address this on a worldwide basis.
Great, thanks, Jack. And actually, I'll answer a question about why do we need a common set of definitions. Why don't we just call this identity theft and move on? And part of the challenge is, the data matters, terminology matters. So if you think about trying to share between two parties, Greg, you mentioned one of your partners in your pilot talking with one of his fellow credit unions. That dialogue is not going to be effective if you're using different terms. If I say first-party fraud and someone else says authorized party fraud, unless we understand the terms and agree on those, we're not going to be able to have a dialogue, and we're definitely not going to be able to share data and experiences in a way that's going to be most effective. It may be partially effective, but without the same language, we simply will not be able to have an effective dialogue. So we agree that it's useful to share, it's challenging. The Fed is starting to look into data sharing models from around the world and just what works and not, and hopefully it'll give us some insights as to what might be possible if you think about it. And as you say, Greg, technology, AI can allow you to share without exposing PII by dealing with extracts of that information, so it's not shared. So very valuable there. And I'll pivot a little bit and just, I guess, ask for a crystal ball. How do you see synthetics evolving? And I'll give one example I heard, which was surprising. And I mentioned that you can become an authorizer on someone else's account and start to pick up their transaction. So, for instance, my wife is a second authorizer on my credit card and vice versa. Well, you go to dark web, you can actually buy on Craigslist, you can buy for $100 the ability to get on someone else's credit card as a signer and help your own credit. And so that seemed like a really creative way of doing it. And I've heard the most sophisticated fraudsters now aren't even doing it that way because they know people know about it. So the bad guys evolve. So any insights into how you see this evolving, either in the threat evolving, bad guys shifting methods that or maybe what's evolving from a detection perspective? Anything on where are we going from here as far as synthetic identities? And once again, Greg, if you have something, if not, we'll just jump to Jack.
Yeah, sure. I think evolution is key, and that's a great word to bring to this narrative because part of the challenge with the existing solutions that FIs are using is that they're static, and the fraudsters are not, right? They're dynamic, they're learning, they're evolving, they're socially engineering, and that's an area where I feel that an AI platform has an advantage because it's not so much concerned about the individual data points. Let's say a specific social security number or address or IP address. It's more interested in the type of overall kind of perspective or persona, right? The profile of the person who's applying for the application based on what they're filling in their application form. So this is, one of the things that we've been working on is a collaborative AI pilot with a group of financial institutions and some federal regulators, and of course, Jim, you know well, with the Fed as well. And the goal of this pilot is to prove out that, our product can be highly effective at detecting fraud within a single institution, but that's not enough, right? Can we raise the bar even higher by having a kind of a collaborative AI network across multiple institutions and having the government agencies and regulators participate as nodes on the network so they can observe and see what's going on and give their feedback, but ultimately create a solution that's continuously evolving, because fraud is like water, right? It's just going to slip through the nearest crack, and you plug one hole and it's going to go down another one. And I think that's probably the most interesting space where this collaboration is really going to have some serious traction in terms of mitigating this crime. Where it goes afterwards is another question. So some of the conversations and feedback we're getting from the federal regulators and folks in our pilot is we want to go beyond just purely identifying the fraud. We want to understand the behavior, moving into the space around threat intelligence. Because certainly, what are the fraudsters, the synthetics doing with this money, right? They're using it for money laundering. They're using it for all types of bad stuff, right? It's not just scamming the banks out of tons of money. It's all around, there's issues around terrorism financing and human trafficking and all the worst possible things. So, by bringing it up a level and having AI sit on top of the existing static rules and really take it to a next level, we can start to look at different types of analysis around threat intelligence, which I think could have a really important national security implication.
Yeah, to add to that, Jim, what Greg was saying, I would say since the beginning of time, since the first time somebody was tapping on a stone tablet, fraud's been going on. So if anybody thinks we're going to solve fraud, with air quotes, good luck with that. However, I do think there's things we can do, and to that point around AI, I think that's critical. It's not thinking about what the next big fraud thing is going to be or what the fraudsters are going to do. I think this is where AI is critical, whereas with linked analysis, you're taking all these activity, all these things going on, all these unique little tiny patterns that by themselves don't mean anything. And then if you take that across credit unions, for example, you see accounts set up, they're transacting fine, but then all of a sudden we notice that same phone number, for whatever reason that's tied to a legitimate account at one financial institution, is making inquiries through an IVR and totally different accounts with a different name. Or maybe at another transaction, we're seeing the same IP addresses being used going into e-banking. Thousands of little things that by themselves may not catch anybody's eye, but with AI, machine learning, it starts to capture these things, starts to learn them, and then realizes that these points are getting more and more frequent and are able to actually reach out and put a stop to it so we can stop the fraud before it happens. I think that's the way we're going to have to go, because we're just not going to be as, I think in that regard, when somebody's thinking up a new fraud trend, we're going to have to use different patterns, different tech, in order to get us to where we're sensing things that are happening through technology in order to react to them.
Great, thanks.
If I can add one thing to that, Jim, and I know you probably have some other questions queued up, and we'll be brief. I love what Jack is saying. Thousands of little items that may be insignificant to a human, but in aggregate could be very significant. We call that broadcasting collective suspicion, and I think there's a lot of good that can be done within the financial institution and for the financial services industry as a whole by adopting this new modern approach. So I love what you're doing with the linked analysis, and I would be interested to maybe incorporate some of that into some of the technologies that we're using too.
Great. Thanks, Greg. So we have about 7 minutes left. One question I'll answer very quickly. Do we see synthetics in other industries? And in our research, we found them in healthcare. We found them in medical services, auto loans. We heard $800 million in auto theft through this. And what they're doing is mostly taking the cars, shipping them overseas, either as a money laundering or just a way of absconding with the physical good and then selling it. So huge in the auto industry, and now we're seeing it in insurance as well, in synthetic identities. Another question either is, during the current pandemic, are there any other additional opportunities for the bad guys to capitalize on synthetics? Greg, I know you had recently at a webinar I was on the perfect storm, of which was part of it. Can you comment a bit?
Tons. Yeah, tons. I mean, if you look at it, what are the three factors driving synthetics? So, low interest rates, right? And thanks to you folks at the Fed. Thank you very much for lowering interest rates. That's been very helpful. So that's obviously, precipitating a lot of new lending applications. Combined with financial recession, obviously financial crime goes up significantly during recessions. I think more than 100% in 12 months in 2008, according to FBI stats. And then lastly, the whole world just went online, right? So, that personal branch experience has been greatly diminished, and that obviously creates massive opportunity for the fraudsters to come in, and through the noise, the banks and the credit unions are just overwhelmed by the online applications and digital strategy. That creates great opportunity for the fraudsters to kind of get lost in the noise there and do their bad stuff.
Jack, anything to add on that front? Or?
Yeah, no, absolutely agree with that assessment. As we look at the switch and we see it in digital and people that weren't using things like contactless cards, even on the card space, right? Everything has changed. The amount of online traffic and purchases. So that in itself, where that whole channel was just much more fraud in that channel as we've moved into chip cards and things like that from the card-present environment, you've just essentially really turned it into the Wild Wild West. And to Greg's point, staff, distraction, perfect opportunity for new account opening to slip through the cracks. And that's why I think it's more important than ever for us to, go down this path of how we're going to solve this.
Great, and I have one addition there, anecdotal, but shows how creative the bad guys are. I mentioned that synthetics sometimes create businesses, and those businesses are used to launder money or also to be fake storefronts. But we had heard of some businesses actually applying for PPP loans, synthetic businesses, and basically paying their synthetic employees. So it just tells you how creative these fraudsters are and take advantage of any situation. Another one for Jack. We talked about systems that the bad guys can understand the the bad guys can see the patterns you use. They understand how the systems work. Are there tools that the bad guys are using to try to understand, what controls you have, et cetera? Or is this just they understand, the regulations? Is it automation and tools, or is it more just they know how banks work and credit unions?
Yeah, they do know that. They do share that information, but it's going deeper than that. They're actually also employing new tech and AI. I always make the comment, there's a vice president of fraud sitting in a country somewhere, but it's not the kind of vice president of fraud that we have working on our side. They're truly looking at ways to penetrate, figure out, get through the networks. Even if let's say a new bit of consortium data comes out, new models come out, they are immediately testing, and they're actually using machine learning, AI, to figure out, okay, what is the peak dollar amount, the velocity? How can I move left? How can I move right? So it's not just the regulations and how they penetrate. They can actually immediately start adjusting how they're trying to penetrate whatever channel they're in based on the feedback they get. And that's another thing we see. We can see in one institution where the testing is going on, and at another institution, whoever's doing that testing, we can see that they actually are doing something in another channel, and all of this is toward bust-out fraud at a later date. So again, this is why technology versus technology is going to be a key thing for us for the future.
Okay, thanks. In the waning minute or two, question, so if an organization does not rely on technology or AI, is there anything else they can do? What else can they do to help protect themselves in the early stages of their fraud mitigation work?
let me take a quick shot at that. Well, first of all, I just have to say, if an organization isn't looking at applying technology either through a partner, if they can't do it themselves, to Greg's point in terms of the capital investment in that, to look for partners that can help them, they're soon going to be on a dark web list of organizations to target. Now, having said that, technology is only one leg of the stool. You have to include your processes and people. So as you're looking at your overall, what do you want to do for the future, you've got to recognize that you could spend millions of dollars on really cool tech, but if you don't have well-documented processes and you don't educate your people to follow those processes, any amount of technology is not going to save you. We've seen that in countless breaches. It's not people in Ninja outfits sneaking in and taking over the systems. It's the contractor with a bad password or password 123, or people just letting things go through phishing exercises. So really, all of these events, including synthetic fraud, focus on those other two legs of the stool.
And as the technology guy, I can actually maybe just add something there that's non-technology related. And I think that just as Jack said, the human perspective, right? So the customer service, member services folks that are getting calls from people that are asking leading questions. The fraudsters are out there, they're socially engineering, they're figuring out the systems and policies and procedures of banks, and then they're tailoring their technology kind of a frontal attack based on what they're learning. So I would advocate to educate the service folks to be cautious around that. That said, I mean, one of the objectives of our pilot is also there's a strong willingness for collaboration from the large to the smallest institutions, and we would welcome institutions who are concerned about not having the bandwidth and the capacity to invest heavily in technology. We would welcome them to reach out to us and learn more about how they could participate in kind of with their peers in a very effective way. So to make this technology available, I think there's a duty on us as innovators in the space to make this technology available to everybody across the spectrum, and it certainly should be possible to do that.
Great, thanks, guys. So let me personally thank you both for your time and your great insight. We definitely got experts on the call today. Let me just turn it back to Mary Ellen for some closing comments.
Thank you so much, Jim. On behalf of the Federal Reserve, let me thank our audience today for their time and their interest. We do appreciate your taking the time out of your busy schedules as you're working from home during this pandemic, and know there are lots of competition with other webinars for your time. So we do appreciate it. Note that we will post a recording of this webinar on our website, fedpaymentsimprovement.org. In addition, we invite you to watch for additional information from the Federal Reserve on this topic. We will continue to educate the industry about synthetic identity fraud. We're also thinking about how to develop a consistent definition of it. Last but not least, you may obtain updates by joining the Fed Payments Improvement community and engaging with us on social media. So again, I point you to our website for that. That concludes our webinar. Thank you again for your time.